You work harder, you put in the hours, you check your bank account, and yet, somehow, life just keeps getting more expensive. Today, we're doing a deep dive explainer into the hidden mechanics of our modern economy. We aren't dealing in opinions here. We're looking strictly at the data behind the rising costs of housing, the crushing weight of modern debt, and how we actually pay to just live our lives.
So why does it never feel like enough? It's a dangerous, uncomfortable question, right? Millions of us are feeling this unprecedented level of financial exhaustion. But here's the thing. That sensation that you're working way harder just to afford less, it's not just in your head. It is a cold, hard, mathematical reality playing out all around us.
$18.775 trillion. Let that sink in for a second. According to recent Federal Reserve data, that is the total household debt in the United States right now. It's a completely staggering, record-breaking number. But how exactly did we get here?
Well, that brings us to Section 1, the cost of modern survival. Let's look at the macroeconomic reality of why everyday survival is quietly but surely draining our bank accounts.
The data here is clinical, but honestly, it's devastating. Over a recent 5-year period, the U.S. inflation rate hit 22.6%. But if you look across a major index of corporations, the nominal median pay increase was only 16.3%. Wage growth is literally, mathematically, losing the battle against inflation. The gap between what everyday things cost and what you actually earn is just widening.
Because here is the harsh truth. Survival costs money. Economists call this demand inelasticity. It basically means that for things like groceries, gas, utilities, insurance, you don't really have a choice but to pay. This financial squeeze we're all feeling, it isn't driven by buying luxury items or taking lavish vacations. It's driven by the inescapable, fundamental costs of daily survival. Moving on to Section 2, the education and housing trap. Traditionally, these two things were supposed to be your guaranteed tickets to the middle class, right? But today, they've morphed into something else entirely. First, look at the education reality. Public perception is shifting incredibly fast, mostly due to astronomical fees and heavy student debt. There's what experts call a declining graduate pay premium. Basically, the financial reward you get for actually having a degree is shrinking. Get this, 1 in 3 graduates now earns below expectations. So instead of guaranteed opportunity, higher education is increasingly delivering heavy debt before a career even gets off the ground. And then there's the housing market. Researchers analyzing the current housing shortage noted something fascinating and a bit terrifying. They say the crisis is replacing merit with, quote, patrimonial capitalism. What does that actually mean? It means homeownership is increasingly tied to family wealth, not your own hard work. The data shows that over a third of first-time buyers relied on a family gift, averaging well over $100,000 just to enter the market. So, if the entry fees for our normal life have skyrocketed and wages really haven't kept up, how is everyone surviving? That takes us to Section 3, the perpetual debt machine. Welcome to the debt economy. Because survival costs consistently outpace wages, borrowing money has become completely normalized. We're talking credit cards for groceries, massive auto loans just so you can drive to work. Debt is no longer a tool for getting ahead. It's a fundamental tool for daily survival. Here's exactly how this dependency pipeline works. Step 1, you borrow money to cover a financial gap. Step 2, interest builds up. Step 3, you're offered a minimum payment option that, hey, actually feels manageable for a minute. And step 4, because that minimum payment barely touches the actual principal amount, you are locked into long-term dependency. It's a trap. The crucial point here is how the math actually works against you. Say you have a $3,000 credit card balance at a 24% interest rate. A minimum payment might be around $90. If you pay only that, it takes over 5 years to clear and costs you $1,800 just in interest. But if you pay a fixed $200, you're done in 18 months, paying only $640 in interest. You see, minimum payments are legally structured to maximize revenue. They are designed to keep the borrower on the hook for as long as possible. And it is definitely not just credit cards. $1.68 trillion. That is the record level of auto loan debt currently held by Americans. Driven by surging car prices and sky-high interest rates, the average monthly auto payment recently hit $680. Just driving to your job has become a massive financial anchor.
Next is Section 4, the cost of medical care. Because we really have to factor in the most inescapable and unpredictable burden of all,
According to extensive polling data by KFF, healthcare costs are the absolute #1 financial anxiety burdening American families today. 64% of adults report being worried about affording healthcare. That completely dwarfs worries about gas, food, or even rent. A single medical emergency can completely derail your household budget, forcing you right back into that very debt machine we just analyzed.
So when you combine stagnant wages, inelastic costs, massive housing barriers, and completely normalized debt, what does that actually do to a person? Let's look at Section 5, the psychological toll.
There is a profound mental cost to all of this. Unrelenting financial stress doesn't just sit politely in a spreadsheet. It fundamentally alters your sleep, your mental health, your everyday behavior. For so many people, the pressure literally never turns off. And the real-world impacts of this stress are highly visible. Polling shows a record share of people feel their personal finances are actively worsening. And it goes way beyond just the individual. High housing costs force essential workers, think teachers, nurses, into extreme commutes far outside the cities they serve. This creates chronic labor shortages, severe career burnout, and a massive productivity drain on the economy itself.
Which brings us to Section 6, who actually benefits? I mean, if millions of people are trapped making minimum payments just to stay afloat, where exactly does all that money go?
Data from the Executive Excess Report reveals a pretty stark divergence. Between 2019 and 2024, at the lowest wage corporations, CEO compensation rose by a staggering 34.7%. Over that exact same period, U.S. inflation was 22.6%, and nominal median worker pay at those very same companies rose only 16.3%. The numbers clearly show wealth actively funneling upward.
The systemic beneficiaries are crystal clear. Credit card issuers extract massive profits through interchange fees and relentless compound interest. Corporate structures heavily reward executives while squeezing wage earners. Starbucks, just as one example, recently showed a CEO-to-worker pay ratio of 6,666 to 1. Asset holders watch their wealth grow through compound returns, while those relying solely on their labor fall further and further behind.
The reality is the modern economy doesn't just tolerate this debt, it absolutely requires it. The system functions because you keep spending, and because your wages aren't enough to cover it all, the system requires you to keep borrowing. So, what is the ultimate takeaway here? The widespread financial exhaustion that so many of us feel, the debt, the housing squeeze, the stagnant wages, it is entirely validated by the data. If you are struggling to keep up, it's not a sign of individual failure. It is simply the cost of modern survival in an economy that's structured exactly this way. Which leaves us with one final, incredibly important question to reflect on. As you look at these widening gaps and these highly profitable debt machines, was the system ever actually designed to make financial freedom easy?